Good morning, good afternoon, and good evening, and wherever you are in the world, welcome to the first monetary blog of the Monetary Policy Institute. This blog is about the current financial crisis or the failure of the Silicon Valley Bank, its repercussions, and possibly policy prescriptions. We have three great commentators today, but before we get to them, I just want to say a few words. Yesterday's announcement by the Federal Reserve to raise interest rates for an 11th time, I think, was very telling about what the central bank considers a priority, inflation or financial stability, the banking system. And I guess it chose inflation by raising interest rates by only 25 basis points. Interest rates in the US now are close to 5%. And it raises questions about how the Federal Reserve what it thinks about the banking system. In defending his decision, Powell yesterday did say that the US banking system is sound and resilient. And this reminds me of comments that Ben Bernanke made in March 2007, and then again in January 2008, saying the economy was resilient and there was no recession forecasted. Yesterday, also, Elizabeth Warren called Powell a dangerous man to be in that position. And this is certainly something that's being repeated by others as well. So today, to talk about the Silicon Valley Bank fiasco, maybe even Credit Suisse, we have three guest speakers. The first is Frances Coppola. She's an economic and financial writer and commentator with a very long career in banking. I looked at her bio yesterday and I loved her byline was, "I used to work for banks, now I write about them and about finance and economics generally." She has contributed regular opinions and columns to the Financial Times and Forbes, among other places. Steve Keen is an Australian economist and author, now living, I don't know, Singapore, I'll say, somewhere. He is a fierce critic of neoclassical economics, authored a very famous book called Debunking Economics, and his latest book in 2021 was on the New Economics, a Manifesto. Finally, Anne Pettifor, British economist who advises governments and organizations. She has published several books. Her work focuses on the global financial system, sovereign debt, restructuring, international finance, and sustainable development. She is best known for correctly predicting the financial crisis of 2007 and 2008. So, without further ado, I guess we can begin by inviting Frances to open this webinar.
Hi everyone, it's a real pleasure to be here. I thought I'd start, since kind of banking is my beat, by actually talking through a little bit about what's happened, because everybody's talking about Silicon Valley Bank and about Credit Suisse, but actually they're not the only banks that have failed. Silicon Valley Bank's failure was preceded 2 days earlier by the failure of another bank called Silvergate Bank, which is a crypto-facing bank. It was providing banking services to crypto exchanges and platforms. It had originally been a home lending bank, and for that reason had a credit line at the Federal Home Loan Bank of San Francisco, as well as at the Federal Reserve. But it had decided that it was going to pivot away from this because this wasn't terribly lucrative, was it? And provide depository and payment services to crypto exchanges and platforms for which it would charge fees. And it rapidly became one of the two go-to banks in the US for crypto exchanges and platforms looking for a banker to handle the on-off ramps for US dollars, to hold deposits dollar deposits on behalf of their customers, and enable them to move dollars around. The other bank is Signature Bank New York, which you may recall is the third bank that failed. It failed 2 days after Silicon Bank. It was seized by the New York regulator and handed over to the FDIC for receivership. So the US's two main crypto banks have both gone down, and you can draw a straight line from the failure of these two banks back to the fall of the crypto exchange FTX last November, because they were the banks for FTX. And when FTX failed, and not only for FTX, but for other exchanges and platforms as well, and when FTX failed, they suffered a proxy bank run. Now, we don't talk enough about this in relation to banks. The banks, we think of a bank run as being the famous Northern Rock style queue up outside the doors of the bank to come and get your deposits, right? But you can actually have a type of bank run which is not directly on the bank at all. It's on the bank's customers. Now, we saw this in 2007 and 2008, when we had a run on the shadow banking system that fed through to regulated banks, because the shadow banks were the customers of the regulated banks. And that's exactly what happened after FTX fell. Customers across crypto rushed to withdraw their dollars from the crypto ecosystem. And because of that, Silvergate and Signature Bank suffered enormous outflows of deposits. They both funded this largely by drawing on their credit lines at the Federal Home Loan Bank. This wasn't too bad for Signature, because Signature did have a very large real estate portfolio. But Silvergate, it had a much smaller real estate portfolio, and it had said that it was pivoting away from real estate. So it's drawing on the Federal Home Loan Bank to the tune of $4.3 billion in less than 3 months, raised quite a lot of eyebrows. And there were quite a lot of questions asked about whether it should be able to draw on a federally guaranteed home loan bank in order to finance a run on crypto exchanges. It decided to repay all of those loans. And to do that, it sold securities. In fact, it didn't raise quite enough money by borrowing on the Federal Home Loan Bank to fund the bank run anyway, because it's the deposits out of its accounts totaled something like 8 billion. And by the end of December, its deposits had fallen by 5 billion. So it needed more money anyway, but it had sold some securities. And then in January and February, it sold a whole load more securities to pay off its home loan, borrowing. And then in March, it announced that because of this and because of a few other things that have been going on, it couldn't deliver its full year accounts on time, and its auditor was not too happy about what was being said, and it was going to have to restate its accounts because of all the securities it had sold, and also because the securities it had sold had not been carried at market price in its own books. It was also going to take a very much larger loss than its preliminary results had indicated. In fact, it was insolvent. And we now know that the FTIC went in later that week, had a good look at its books over the weekend, and at the beginning of the following week said, yeah, you're insolvent, and told its parent to close it down, and it went into voluntary liquidation. The Silicon Valley Bank had essentially the same business structure. It wasn't doing obviously crypto-related business, but it was dealing with largely tech customers, tech businesses who all knew each other in much the same way that crypto platforms and exchanges, people who run them all know each other, and their customers all know each other. It's the same kind of correlated herding effect. The day after Silvergate Bank went into voluntary liquidation, it was warned by Moody's that it had essentially the same business structure and it was going to be downgraded unless it did something to shore up its balance sheet. So it decided to restructure some of its bonds. It was going to sell its longer dated available for sale portfolio and refinance it with treasury bills. And it was going to finance that with capital raise. The only problem was its share price was already falling. And the shareholders looked at this and looked at some of the chatter there'd been on Twitter and some of the things that people had been saying about it, including me, I have to say, saying, actually, do you know you've got 15 billion of unrealized losses on your held to maturity securities that are not even in your accounts? And if you have to sell those securities, you're going to be insolvent. And the shareholders ran. The capital raise fails. It had to pull it. And following that, there was a fatal bank run on Silicon Valley Bank. It lost $42 billion in one day. And at the end of Thursday, it was running an overdraft at the Fed to the tune of nearly $1 billion, which it couldn't cover with collateral. And so the California regulator and the FDIC closed it down at that point. And then 2 days later, Signature Bank was likewise closed. Now, I think we should see all of these banks as correlated. They have the same kind of customers. They have the same kind of business structure. They are mid-sized banks that have lobbied hard to be excused from the regulation that is imposed on bigger banks. They claimed they were not systemically important. And then when all this happened, they then decided they were systemically important and could they please have a bailout in the form of unlimited deposit insurance. And I have to say, I did think it was unfortunate that Janet Yellen agreed to it. She has now read back on this because, of course, what happened then was the other US mid-sized banks all decided that they too should have unlimited depositor insurance because they've also got unrealized losses on government securities and they've also got a whole load of uninsured deposits that could run at the drop of a hat. So they too should have the same protections as Silicon Valley Bank and Signature Bank have had. And we suddenly got an association of about 180 banks saying, please lift the FDIC limit. Janet Yellen has now said no, and we've now got this interesting situation where 2 banks have been bailed out and the rest aren't going to be. And you start to think your regulation and your supervision and your bank resolution has got itself in a bit of a pickle. So that's kind of where we are in the United States. And in the middle of all this comes Jay Powell saying, I don't think any of this has got anything to do with monetary policy. I'm going to raise rates anyway. We have got other ways of sorting out banks. Oh, by the way, banks, here is a term lending facility which will allow you to pledge your collateral on which you are losing shed loads because of rising interest rates have made the value of your bonds fall. You could simply pledge your bonds at their face value and get loads of money to finance bank runs. I struggle to see how all this fits together into a responsible way of managing a banking system.
Okay, well, thank you very much. Thank you very much. Look, I've got lots of questions. We'll save those for the question period. But thank you very much. Sorry?
I hope people are keeping notes.
Thank you very much. Steve Keen just now joined, but in order to give him maybe a couple of minutes to collect himself, I suggest we go to Anne for her comments, and we'll circle back to Steve Keen at the end. So Anne, please go ahead. You got the floor.
Thank you very much. I'm unmuted, am I?
Yes.
Good. Right. Well, thank you ever so much, and it's good to be here. It's intimidating to have to follow Frances, but it's wonderful to have her because of her understanding and knowledge of the banking system. I want to pull back and look at the macro picture, if you like. And of course, I see it very much from a British perspective. And that is that our central bank, together with the Federal Reserve and the ECB, decided that they wanted to raise rates to tackle inflation. And they very specifically, in the case of the Bank of England, Andrew Bailey, mentioned wages as being a source of inflation. And this at a time when real wages were actually falling. And it seemed to me then that the central bankers were actually the elephants in the room of the global economy. And they were trampling around, not really knowing what they were doing, but acting what I think is in very ideological ways. And that particularly applies to the governor of the Bank of England. And as a consequence, that immediately began, I think, to destabilize the system. I mean, the fact is that we have a global economy that is heavily over-indebted. Private, I am credited with having predicted the financial crisis, as did many others, including people on this panel. So I don't want to boast about this, but the only reason I was able to see what was happening was because I looked at the total amount of private and public debt relative to GDP, relative to income. And it was very clear to me that that debt was not going to be repaid. And at the moment where rates rose sufficiently to act, if you like, as a dagger bursting the balloon of the ballooning of private debt, that was going to cause a crisis. Of course, I couldn't get the timing right, and I didn't get the timing right. I want to stress this. But today, whereas total debt was something like 256% of GDP back in 2007, today it's 300% plus. Right? And the IMF and the World Bank are panicking about this, and it has particular implications for low-income countries. And for me, what has been so unfair about what has happened in these last 10 days is that central bankers have behaved as if they're not aware that they are the elephants in the room, and they're trampling over the economy. They're trampling over the living standards of working people. They're trampling over the living standards of low-income countries. And yet they proceed forthwith. And they have these enormous powers, in my view, because they are backed by, and I always argue this, taxpayers. Essentially, that is what gives them the power to create liquidity, and yet they're not accountable to taxpayers. They seem determined at a time of a cost of living crisis to actually make things worse. So this is happening certainly to consumers in Europe and in Britain, and increasingly in the United States. But what is also happening is that countries of the South are now burdened by enormous amounts of dollar-denominated debt, which each time the Federal Reserve ratchets up interest rates, increases their burden of debt, because it increases the strength of the dollar and weakens their own currencies. And that brings me to what is actually happening here as we speak, which is that 40 African countries, led by South Africa, the country of my birth, are currently in Moscow, meeting both with President Putin and with President Xi. So the story is that the China and Russia relationship is being forged in Moscow, but that together with 40 African countries. So what we're seeing happen is begin the divergence, or if you like, those economies sort of overwhelmingly backed by the US dollar, and those who suffer as a result of the dollarization of the global economy. And that has become particularly unjust when the Federal Reserve talks about and then arranges swaps with countries which it calls its friendly countries, the 5 countries that belong to this inner circle and who may have a shortage of dollars. They are provided on a daily basis now by the Federal Reserve with additional dollar liquidity. This is not a privilege accorded to poor countries, to low-income countries, to countries outside this magic circle. And this is increasing the divergence between North and South, between East and West. And it's becoming, in my view, quite serious. And then if you add on to that, something that Kathleen Tyson has pointed out, which is that American banks were invited to exchange their securities, which had been, if we're marked to market, we had been devalued by 30 to 40% at par with the Federal Reserve. But this cannot apply to foreign investors and to foreign holders of US Treasury bills. So an awful lot of institutions and countries and people are being subordinated, if you like, to the interests of US banks, and are finding that the value of their treasuries is 30 to 40% below what it is for those who have the privilege of accessing federal resources and exchanging their treasuries at par. So what we see growing up out of this crisis is this massive divergence, political, ideological, but also economic and financial, between North and South, between East and West. And this is serving, in my view, to empower Mr. Putin and his allies, including Turkey, India, of course. India and China is mending their relationships. The Saudis and the Iranians are mending their relationships, all as a way of protecting themselves from, if you like, the imperialism of the US dollar. So I think this crisis is just bringing into focus this bigger international macroeconomic crisis, and it is extremely worrying. And I'll stop there.
Well, thank you very much. Very interesting. I have to admit, I had not thought along those lines. So this was very interesting for me. Thank you very much, Francis. Um, and now our last guest today is Steve Keen. He has joined us recently. I'm assuming he's still on. Steve, if you're on, please say hello.
Hello,
Good.
here. My apologies for being late. I was really working on other garbage by neoclassical economists for talk I'm giving at 6 o'clock, and I lost track of time, which of course almost makes me a neoclassical economist, but there you go.
No, I speaking of that, I want to say as a journal editor, whenever I publish a paper and it gets, you know, metrics of 25, I'm going, yay, what a huge paper. And then I look at your paper criticizing ecological neoclassical economics, which has metrics of thousands.
2000. Yeah, it's fallen back a bit
I'm
recently.
going, oh
Yeah.
my God. And then I get upset and I stop talking to you because you didn't send me that paper. So, okay. So
Okay.
everyone, Steve Keen.
Okay. Well, again, my apologies for being late. I should have been here on time, and just, as I said, focusing on the other garbage they do, apart from what they're doing to the financial sector. I got caught up in it and carried away. I want to hear what Francis had to say. I'm sorry not to have been at your talk, Francis. My main focus is on this particular thing is looking at the impact of the devaluation of bonds on the solvency of the banking sector. Because when I first looked at the raising interest rates that they were doing to fight inflation, and if those of you who don't know Blair Fix's work on that, I highly recommend looking at Blair's work on how useless it is to use interest rates to control the rate of inflation versus the opposite, inflation controlling the interest rate. But I was looking at that, what it would mean to credit demand, and I neglected the impact on the solvency of the banks by reducing the value of their bonds. Now, of course, what's actually happened, and SVB is the canary in the coal mine in that sense, because it had so many long-dated bonds, which would in the past would have been seen as being conservative, the valuation was trashed by the raising of interest rates. And that's the real danger, that while the bank was focusing on its neoclassical DSGE, put up the interest rate to control the rate of inflation bullshit, but that's a technical term, as we'd all recognize here in economics, they were ignoring the impact this had on the solvency of the banking sector. And though I'm seeing SVB criticised for not using interest rate swaps properly, blah, 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 the thing is, you can't swap out for the system the impact of the degradation of the quality of the assets by increasing the interest rate. Now, if you think of it as well in terms of the long-term perspective, ever since they've been dropping interest rates, that goes right back to Vokla, the end of Vokla in 1982 or 3, that's been increasing the solvency of the banking sector. And the further the rates go down, the more dramatic that effect is. So to illustrate that, I'm going to bore you all with a shot of my Minsky software. There's an extremely simple model, but just to illustrate what's going on here. So this is a simple model of the banking sector, where I'm leaving out all the usual stuff that I'd include here, you know, lending, et cetera, et cetera. So I simply have, if you can see my screen, okay?
Yep.
Most of you can. Okay. I simply had the banks having reserves of assets and bonds. I'm not changing the amount of bonds. I'm just literally leaving everything fixed and loans. And those numbers are roughly in the ballpark in terms of billions of dollars worth of the situation for the banking sector in America. And what you have is interest rates are currently set at 3%. I better reset that. And what you have is that the interest that banks are being paid on bonds is fixed because of the coupon value. So they're looking at having fixed interest rate bonds. So the interest on bonds doesn't change from 945 billion per year, because that's 3% on $31.5 trillion worth of bonds. And then they've got interest on loans as well. So I've got those two don't change at all. I have spending being affected by the equity the banks have. So the basic notion here is normal people and businesses spend out of their deposit accounts, banks spend out of their short-term equity. I'm ignoring long-term equity here as well. And they spend slowly compared to what the normal economy does. And now when you look at this is the interest calculation, which just come out at, as I said, 945 billion a year. But the value of the bonds, and I'm taking the extreme situation here of pretending that all bonds are consols, and this makes the mathematics easier. And that therefore means that as current interest rates go up, the value of that 945 falls, and therefore that comes through and hits the market value of the bonds, which then forces the banks to revalue. Now, of course, I know they've got various accounts, hold to maturity and things like that, which they put in to try to evade the impact of that. But in the aggregate, this is the overall impact. So let's see what happens. And by the way, I'm using higher interest rates than they started from, because if I did the higher interest rates, the value of bonds would go from 31 billion to about 500 million in one hit, because of how sensitive consols are to interest rates. So if you run the system at the moment, I get the equity of the banking sectors fixed at this roughly $5 trillion. No need to mark to market. They're spending as much as they would normally do out of their assets. And then you bump interest rates by 1%. And oh dear, terribly sorry about your equity. Okay. So the valuation would fall from $5 trillion to $1 trillion. And if I hit them with two interest rates, which of course is pretty much what was done over time, this is again exaggerating how fast it's doing because I'm doing it in 1% stop steps just to get something dramatic to turn up on screen. But at 2% rate of interest, you're into negative equity. So that is the basic problem. And this is the sort of thing, this should be a piece of software developed by the Federal Reserve, not by me. Okay, they're the ones running your monetary system. As we all know, they have DSG models that have neither debts nor bank nor money in their models. And they're simply, you don't see what you don't model. So they don't see this stuff at all. They couldn't even do it now because, as far as I know, nobody in the Federal Reserve is using Minsky. But the obvious point is, if you drop interest rates, you reduce the value of bonds. In the aggregate, you're damaging the asset side of the banking sector. That will force some of them to go bankrupt. And we've seen the first three canaries going now. And if they keep on raising interest rates, there'll be more. So there's more to add, but we can do the rest of the discussion.
Okay, thank you, Steve. Thank you very much. We'll open the discussion, but I do want to mention a couple of comments from the chat room. One is by, I believe, Najib Khan. Yeah, Najib, hello. Thank you, Anne. BRICS countries are also launching a new currency, a basket of 5 currencies: Chinese, Russian, Indian, Brazilian, and South African currencies to be used as a reserve currency akin to the SDR of the IMF in order to reduce the reliance on the US dollar. Paul Tulloch, we went from a system where those that were being safe with investment policy to changing that safety into a penalty.
Yep.
So those 2 comments. If you have any comments, please raise your hands, use that icon. We're going to have the first one by Eben, and I ask you that you, of course, unmute yourself and ask your question.
Thank you, and thank you for taking questions. A great presentation, our 3 speakers. Last week, Janet Yellen made some comment about massive asset devaluation as a result of climate change, or coming to terms with the 30-year horizon, which many of these bonds are, on that kind of horizon. And it was mentioned in the presentations about how once these were thought to be very conservative investments. But I guess my question is, in the face of IPCC warnings, we have quite a number of assets, bank assets, that are, starting with the stranded assets in the oil industry, and then expanding that to what other assets would be stranded that just won't be able to be realized given some of the realities of climate change. And are we seeing, in some ways, the metaphor canary in the coal mine over crypto exchange, which is just kind of a weird side thing? Is there some real come to Jesus moment about some of these assets that are just not going to be paid off in the 30-year horizon and devaluing the bank assets? I don't know if that question made sense, but.
Yeah, well, probably the person doing most of the work on climate change right now, I think everything's going to zero. If you take a look at how totally out of step economic estimates of climate change are with what climate change actually is. You have morons like William Nordhaus. By the way, we should rename it the Stupid Prize in Economics to make it clearer what it actually means when you get a Nobel Prize. But the winner of the Stupid Prize in Economics of 2018 said that a 6-degree increase in temperature would reduce global GDP by 8.9%. If you read the scientists on that, a 6-degree increase in temperature will reduce humanity to a relic and probably knock off 95% of the mammalian species on the planet and a fair percentage of the insects and invertebrate as well. So they have ludicrously underestimated the impact of climate change. They think it's going to hit us in 2200 or 2300 with any major severity. Scientists are really saying it's the next 10 to 30 years that we're going to see catastrophic impacts. And that's the markets have taken the economists seriously. So the markets have completely underestimated the impact climate change is going to have. So in my opinion, everything's going to zero, and this is just the warm up.
Thanks, Steve. We have 2 questions now. One by my very own student, Chris Land. Chris, you've got the floor. Sideways, but we're still seeing you.
Well, I'll just turn it off then. I don't want to get rid of that. That doesn't matter. Well, thank you very much. It was a fascinating presentation. The first thing I want to say is I want to push back on the idea of a bailout. I'm a bookkeeper for a company. We have about 50 employees. If the bank branch where we hold our money were to fail, we wouldn't be able to make payroll and we'd be out of business. And I think that was true for a lot of the customers at Silicon Valley Bank. They were actually businesses that held payroll at that bank. And quite frankly, the $250,000 cap on deposit insurance is just not adequate. I also wanted to say, though, too, that I'm a firm believer that bank failures are a lack of regulation. It's a failure of regulation more than anything else. I point out that in Canada, we've had 3 banks fail in the last 100 years, one in 1924 and 2 in 1989. And because I think that our banking sector here is regulated quite a lot better than many other places. But my question is, the theoretical raising of depositors' insurance to infinite, what is the moral hazard of doing that? For Silicon Valley Bank, their bondholders and their shareholders are left out of the money that's being sprinkled on them. They're really only rescuing the depositors. So I understand the moral hazard of trying to rescue investors. I wouldn't agree with that. But what is the moral hazard of raising deposit insurance to an infinite amount?
Thank you, Chris. Who wants to take that question?
I think that sounds like my sort of thing, really. Okay, there are a few I want to unpick this a bit, because obviously we heard this a lot in the arguments after the failure of Silicon Valley Bank, not only in the US, but also in the UK, that a lot of the uninsured depositors were businesses which, if they lost access to their funds, would not be able to make payroll. The UK government, I know, was looking at short-term loans. So you should remember that in an insolvency, when you've got a receiver like FDIC, is in the US and in the UK actually was the PRA, then it is their job to recover whatever they can from the assets. And so your problem is a liquidity one more than a solvency one. A properly capitalized bank should not even be imposing losses on uninsured depositors. It is simply a question of access to funds. And what the US government was looking at was putting in place short-term loan guarantee facilities to enable companies to cover their payroll until such time as they could get access to their funds again. It's not clear to me that raising a deposit insurance limit necessarily is any better than that. It does introduce moral hazard for the banks, because if you know that your funding is never going to run and your cost of funding is always going to be the same, regardless of what you do, what kind of lending decisions are you going to make? So there are issues with moral hazard. It's not to do with moral hazard for depositors, it's to do with moral hazard for the banks. But in this case, nonetheless, the decision was made to give Silicon Valley depositors access to their funds early. I'm going to put it like that, rather than saying it was a bailout as such, because the idea is that the FTX should be able to recover this money by selling or winding down the residual assets of Silicon Valley Bank. I just want to pick up something else while I'm on this, though, because there is a risk, and it kind of touches on this whole question of capital and liquidity regulation, which I think has failed in this case, and failed for reasons that are kind of touch on what Steve was saying, to do with, in a way, the whole of our regulation really being crafted for the scenario after the global financial crisis, and not really for what we have now. So we had a bank, Silicon Valley Bank, which was providing depository services and payment services to tech companies. We had another bank, Silvergate, doing the same, and another one, Signature Bank, doing the same. They were all doing essentially the same thing. They were not doing a great deal of lending, but they were doing a lot of deposit taking and lending. They were deposit rich, and they were investing those deposits in government bonds. Now, had they invested those deposits in bank reserves and treasury bills, we wouldn't be having this conversation. The problem was that they invested them in long-term bonds, including in the US agency mortgage-backed securities issued by Fannie Mae, Freddie Mac. Those are like 30 years long. Those are much more exposed to interest rate risk. They moved almost all of those securities into what we call held to maturity, which meant that instead of marking them to market and hedging the interest rate risk, they carried them on their books at face value and didn't hedge them. So when they had to sell those securities to accommodate their depositors' requests for money, they were selling at a loss. And they had those suddenly became realized losses. And that's the problem. So it's both a solvency and a liquidity problem. It is the problem of having runnable, very runnable depositors, uninsured, made up of people who have good reasons to move their money very quickly, because, as you say, they can't make payroll if they lose their money, lose access to their money, and backed by illiquid long duration bonds. The last time we saw that happening was in September last year with the pension funds. It's the same kind of thing, which suddenly had demands for money that they couldn't meet because their assets were all tied up in long dated bonds, and they had to sell those bonds in order to raise the cash, and they crashed the gilts market, the long dated gilts market doing it. Right, it's exactly the same dynamic, and our regulation hasn't allowed for this. It may surprise people to learn that Silvergate Bank's core equity tier 1 capital, that's supposed to be the best capital that protects depositors from losses, was its ratio was in excess of 50% when it failed, and it was actually insolvent. And the reason for that is that the government bonds it was holding were all zero weighted for risk, and because it was not reflecting mark-to-market losses on those bonds in its accounts, it had an opt-out by the regulation. The Dodd-Frank regulation allowed it, because of the size of the bank, to opt out from including mark-to-market losses on government bonds in its regulatory capital calculations. So I agree with you, Chris, that it was a failure of regulation, and the whole thing needs to be looked at again, because clearly we've got a risk here that nobody thought existed.
I'd add to that, maybe going more extreme than Francis here. I don't think there should be any limit to deposit insurance, because that, I see that as an Austrian wet dream, pretending that people are investing in a bank when they put a deposit in a bank. We're not investing, we're putting our money in the payment system. And if you have corporations with, 1 million staff or 2 million staff, they're not going to be spreading their bank accounts amongst 459,000 banks. There aren't enough banks in America, I think. to handle the Walmart payroll and have Walmart having less than 250,000 in each of those accounts. So you look at where does this limit come from? It comes from two things. One is, I think, an Austrian type attitude. You're investing in a bank when you put a deposit inside there, and that's really a loanable funds perspective. And the second is the whole idea of fractional reserve banking and all that stuff, of course, wasn't about fractional reserve banking. Thank God I don't need to explain to most people here that that's nonsense, it's textbook fallacy. What that was there for was to stop household runs. Okay, if you had 10% of your money in your assets in money, which was the whole idea of the 10% rule in America, that was of course abolished after the financial crisis. But if you have 10% there, you're unlikely to get that many households turning up. And you check the rules, and O'Brien's paper from 2009 is excellent on that. There was no limit, there were no such controls on business deposits, because they didn't think businesses would be lining up to pull their money out. Well, when you got things like Silicon Valley Bank, when you've got enormous companies and incredibly wealthy individuals, yes, they did line up to take their money out. So it's a sign, just get rid of the bloody limit, means deposits are fully insured, and everything that goes wrong on the asset side is the fault of an individual bank, not the fault of it being hit by a run, which was caused by the fact that there's a limit on the amount that's covered. It's a payment system. Capitalism needs a payment system.
Thank you, Steve. Okay, we'll go to the next question by Tarek.
Do you hear me?
Yes.
Yeah. Well, hello, everyone. Thank you very much for your presentations. I introduced myself very quickly. My name is Tarek Fahim. I'm a PhD candidate in philosophy of economics and at Sorbonne University. Before this crisis, some heterodox macroeconomists were not against raising interest rates, not the way central banks are doing it right now, essentially because of excessive rising real estate prices in some Western countries since the Great Recession of 2008. Which is true in a way. Real estate prices in France, for instance, more than doubled in the last 2 decades. What do you think about this objection against maintaining interest rates at a low level? Is there another way of tackling the real estate speculation without raising interest rates? Thank you.
Let me just chime in here. I've been having debates about this with Marc Lavoie and Marius Echeverria for the better part of a year, maybe more, like a weekly debate about interest rates. And I know that Marc favors higher interest rates. And I've always been sort of against them. Even Marc accused me of being an MMT sympathizer. But for me, I think that I always maintain, and I gave a paper at the Eastern Economic Association in 2008, 2009, excuse me, arguing that low interest rates was not the cause of financial bubbles, of asset bubbles, but the lack of regulations. Now, I know that low interest rates certainly encourages the speculative behavior, but I think if we had a sufficient or comprehensive ways of dealing with that, regulations, then it wouldn't be that much of a problem. Now, the counter argument that I hear a lot is there's always ways of going around regulations, and they're not all that efficient. But it is an ongoing debate within post-Keynesian economics. I'll just go right now to Anne. Maybe Anne had a comment directly on.
Yeah. Yes, thanks ever so much, Louis. And I just want to push back on this idea of central banks lowering rates and keeping them low very deliberately. The fact of the matter is, interest rates were low precisely because the economy was incredibly weak, precisely because the decision post-crisis to separate, if you like, monetary and fiscal policy, to have monetary policy radicalism and fiscal policy conservatism, really helped consolidate the crisis, made things worse. It kind of dug the hole deeper. And And as a result, there was no demand for loans. And it's that weakness of the economic that results in low interest rates. So I see them as a consequence of, and not as a deliberate policy. So then the other problem then is because with low rates, with this very severe weakness in the economy post-crisis, there was also not sufficient regulation of credit and of lending. So it was possible to borrow crazy money and to use that to obtain collateral, which would enable you to leverage additional borrowing, crazy borrowing, so that we now have an overhang of debt, massive overhang of debt. And the central banks sat on their hands, governors and central bank governors and regulators. And it's that's the problem. If we'd managed, A, the weakness of the economy, and B, the tendency to borrow crazy, and to borrow for rent-seeking purposes, not for investment purposes, not for investment in sound economic activity, not for investment in dealing with climate breakdown, then I don't think we would have had a problem. So I just feel that we need to get that the right way around. Thank you.
Just to give a historical anecdote, there's a great book on statistics by a guy called Ehrenberg from the 1930s called Data Reduction. Brilliant book, which I made the mistake of lending to a student and never saw again. But in that book, he gives an example of a stable variable in an economy. And guess what he chooses? Interest rates. So basically, his historical data up to about 1930, interest rates were roughly 3%. And when you think about what function do interest rates on bonds and even on reserves fulfill, one thing they do is pay the banks for the cost of maintaining the payment system, which is roughly of the order of 2 or 3% on their assets. So I think there's a reason to have that level of interest rates. But the whole idea of using interest rates to control inflation is an outgrowth of, first of all, J.R. Hicks as opposed to John Hicks in the ISLM as Mr. Keynes and the classics, arguing that you could control the rate of economic activity using interest rates, which was completely fallacious, as we all know here, because that wasn't what Keynes argued at all. It's expectations that determine investment, not the cost, not your net present value calculations. So it's neoclassical economists again who've made this into a control variable. Now, what we actually had people understood the economy running the central banks, we'd be doing things like controlling the level of private borrowing and replying the private debt to GDP ratio and credit management to make sure it went to investment rather than speculation. So again, the focus on interest rates is a sign of how completely out of touch of the economy neoclassical economists are, and they're the bastards in charge of the central banks.
But Steve, I'll add that there are quite a few heterodox people who believe in the use of interest rates to regulate the economy.
And lots of Greens do as well, as a way of sort of, cutting consumption, cutting production, cutting GDP, and
It'll do it now because there's such a high level of private debt. That's what everybody here focuses on that as the major issue rather than government debt. So the massive levels of private debt, yes, interest rate changes have a dramatic impact. And, I'm finally seeing my favorite housing bubble being pricked by this, because Australians are carrying 120% of GDP level of private debt, and with a 3% increase in interest rates, they're all, they can't even afford to buy the plastic wrappers around the McDonald's sandwiches for their kids anymore, let alone the contents. So you're having potentially a crash in that asset market, long overdue, but caused by the wrong effect. So interest rates are, if you're going to increase them enough to stop a bubble, then you trash the economy like Voeckler did. If you're going to have an impact on them, you've got to have high levels of private debt, which we shouldn't have in the first place.
And that's an issue of regulations. Okay, we've got 3 quick questions. Paul Tulloch, our own Najib Khan, and my old New School friend Ronald. So we'll go to Paul.
Hi, thanks for everybody's showing up here and presenting. It was great. I just wanted to go back to the SVB case and give you some firsthand account of what happened. I'm working at Stanford right now in a climate change startup kind of situation, and it's run by Andrew Ng, who is like one of the largest machine learning professors in the world. And he posted something on, I think it was Monday, the weekend that SVB crashed. He runs 4 or 5 small companies that have, well, they're established, they're like medium size, and a lot of them are in climate change. He had several $1 million in that bank tied to payroll. So when the weekend came, obviously there was a lot of talk going on in the chatter, in the Slack channels and other, new ways of communicating that, we talk about Minsky moments and things. It spread like lightning that something was going on in that bank. So of course, Andrew, like any rational person, said, I have millions of dollars for payroll locked up in that bank. I need to get my money, because suddenly everybody was questioning whether they'd be able to access the money. So he did what everybody else did. They actually banded together. They called people in Washington and other such, ways that you're going to do when your payroll is being threatened. So the point I want to make is that, they're not risk takers. They were putting their money in the bank. They're entrepreneurs, they're, computer people. They basically said, put it in safety. So these bankers at SVB, listened, said, okay, we'll put it in safety. Now we can say that, it was locked in, without good guidance, saying, well, you put it in a 30-year 1% bond. That's crazy. But at the same time, they're not risk takers. So by penalizing this group, we're basically saying, well, you should have been out there playing, derivative games and all this other, other financial vehicles that are way more riskier. And I don't understand that logic, because, that's not what you want. You want people to invest in safety at an adequate return that produces, some, savings incentive, so that you can reinvest that at a larger level in the economy. But I just really don't understand that, we have this low interest rate policy, and we're it was in place for 30 years, and now we're trying to blame depositors in a sense, when it comes back to really the FDIC and the regulatory regime for smaller banks, right? Like that decision by Trump to pull back that regulation really was the problem, because these bankers were just acting on their rules. Anyways, that's my.
Okay, thanks, Paul. Does anyone want to take that? Maybe Francis?
Yeah, I know I may, because actually I mean, that was the point I was trying to make, Paul, really, that in a way looking at the insurance limit is almost not the point. The point, it was the failure of regulation underneath this. And it's not just the Trump reforms, by the way. What the Trump reforms did was allow the Fed to take out, essentially to downgrade the supervision on banks with less than 250 billion in assets. It didn't have to do so. It chose to do so. It just gave it the permission to do so, if you like. And the excluding fair value losses on held to market securities from calculation of regulatory capital is in the original Dodd-Frank legislation. It goes back to 2013. It was a mistake then. So it is a long-standing failure of regulation. The whole thing really needs to be looked at again, along with the resolution regime, which, if there's insufficient capital, would impose losses on uninsured depositors, and that needs to be looked at again. And also this whole thing about liquidity, which is really what you're talking about, that the problem is not so much the problem is access to funds. And we saw this before with the Northern Rock thing, that the problem isn't so much whether people can lose their are going to lose their funds eventually because of insolvency, or whether we're going to be able to recover it all by selling assets. We've got the capital cushions, no depositors are going to take losses. It's not that, it's whether they have access to their funds. And as you say, for a company trying to make payroll, they need liquidity. So again, that all needs to be looked at again, about how we ensure that depositors who are simply trying to use a payment system, depository service and a payment system that is supposed to be safe, can be protected from these kind of things. I mean, perhaps, you know, there is an argument, and I know that this has been made by one or two banks in the bankers who want to work with the crypto space, which is all about deposits and payments. Really, there's very little lending involved at all. Whether banks that are doing that really should be forced to hold all the backing for their runnable deposits in bank reserves.
Yeah, my only follow-up to that is, like, we were going along at this low interest rate policy basically to keep this asset appreciation bubble going, right? Whether it was in housing or other financial instruments. The question is, like, do we actually believe the economy is strong and that's why interest rates went up? The economy is weak, like never before. The way I look at it, there's no productive investment happening, which is the sign of a strong economy. We have none of that happening. We have a COVID supply shock chain that, given the geopolitical situation we have right now, we have stranded assets in China, disrupted trade policy, energy price fluctuations that we don't, you know, are wreaking havoc on the system. We have shortages in some food like grain due to a war, you know, all these other things going on. This is a sign of a weak economy, yet interest rates went up. That's crazy.
You know,
why
Paul,
did that go up? These bankers shouldn't even have to have this problem right now. That's, you know, this gets back to the system problem.
Yeah,
Well,
I mean, yeah,
to
sorry.
go back to something that Steve said, you know, it's the neoclassical model. This is based on the Phillips curve. We're at full employment. Unemployment is a record low. So therefore, it must be that inflation is on the horizon. And I really believe that this Phillips curve mentality is what's driving monetary policy right now. And just for the record, there are a lot of heterodox people who believe that we are at full employment, rates have to go up. And I've had these arguments for the past year, and I'm sort of bewildered sometimes when I hear that coming from the mouths from
the economy is broken so badly right now, and yet we're sitting here supporting that interest rates should be going up. Like, we should be talking about why are interest rates going up? It's not about the economy being hot. It's not at all.
And the other thing that's happening with this too as well, and we shouldn't forget, is that this is a Bitcoiner's wet dream. We're destroying the payment system. And if you tell corporations with $1 billion to be used for payments that they're only going to get 250,000 of that insured in the banking system, they're going to be rushing for Bitcoin or anything else they think is going to at least appreciate in value or maybe maintain constancy. So this is crazy. And this, again, there's no reason that Bitcoin should take over the payment system, except that neoclassical economists are in charge of the payment system.
Let me just add one thing. Remember, a year ago, the Federal Reserve was saying, or central bankers were saying, inflation is temporary, no need to raise interest rates. At that moment, financial markets and wealth holders were accusing central bankers of being irresponsible and of being, you know, so that's when I think monetary policy changed. That's when interest rates started to increase. And I think that from a political economy perspective, inflation lowers real value. And those wealth holders did not want to have their wealth decrease. And they just scared central bankers into raising interest rates.
Yeah.
Anyways.
I'm afraid I'm going to have to go soon, Louis. But,
okay, so we're going to take two very quick questions, and that is, please make your questions very, very short. Najib.
I just want to say thank you to Francis, Anne, and Steve. Thank you so much. And then I want to say this to Louis-Philippe. We all love you. Okay.
Oh, well.
Thank you so much.
No, that's my spouse.
A quick comment. Francis already alluded to this. Steve said it was an extreme, in my view, a comment that we should just abolish this deposit insurance. And so I think if we say that, then it's pretty much like the main culprit is deposit insurance, and I just very respectfully I disagree with that. But I would ask Steve, what about the capital to asset ratio? You alluded to a little bit, but how about that? Like, in my opinion, that is the main culprit. Thank you.
Well, if you look at SVP, it had an incredibly conservative asset allocation. I took a look at its loan book and I was just blown away. So it's 70 billion in loans and 200 billion in bonds. Most banks are the other way around, if not more extreme. So we've actually penalised. Okay, didn't do it hedging. All right, okay, sure. But the whole fact it's got to do its hedging is generated by the instability of interest rates. Again, it's what neoclassicals do to fuck up a capitalist economy, thinking they're managing it. So I'd rather, get rid of anything that those buggers can destroy. And if I looked at the SVB's books and I thought, that's what I'd like a bank to look like. What happens? It's the first one to fail.
Okay.
It is what I said, though, if I might say quickly, Najib, that although the model itself looks conservative, in actual fact, a bank that is backing runnable deposits with long-dated government bonds is fractionally reserved, and therefore, it's basically making a return from interest rate risk. And if those securities are being held on its book as held to maturity, in other words, it's intended to hold them for the lifetime of the bond, then it's also not reflecting the interest rate risk in its books. And that is a failure of regulation, and that needs to be sorted out in my book. They shouldn't be able to game the held to maturity rules like that, and nor should they be able to exclude mark-to-market losses on that kind of asset model from regulatory capital.
Thank you. One last comment. Ron, make it short, please.
All right. Can you all hear me?
Yes.
Yes.
Oh, good. Okay. So throughout the lecture, I've been sort of wondering what happened. It's sort of like, well, what about the elephant in the room? That is to say, I've looked back about 2 decades, and every time there's an episode like this, the larger banks manage to acquire significantly increased assets. And so basically what's running now is a derivatives market on the order of several $100 trillion are out. And so, I mean, I just think that the question of concentration needs addressing. That's all.
Yeah. And again, that's why to bring Richard Werner's not here, but one of Richard's main points is you want to have small community banks which are focused on their local entrepreneurs and know who's good and who's bad.
They can't afford finance. They don't have.
Of course they can't. That's what I'm saying. The current system means they can't exist.
Well, that's what the big banks sell them their derivatives, and that's how they make their money.
Neoclassical economists are fans of perfect competition to causing the biggest monopoly on the planet. Yeah.
Bring back Glass-Steagall is what I say.
Bringing back Glass-Steagall wouldn't have solved, wouldn't have dealt with prevented the present crisis, Anne. Unfortunately, I mean, what we have in Europe is the failure of a too big to fail bank and its merger with another too big to fail bank along Lloyd's HBOS style. We'll have to see whether it ends up the same way as Lloyd's HBOS being nationalised by the government. But we've now got extreme concentration in the Swiss banking sector, and I'm not at all sure that's healthy. There's a strong argument for breaking it all up, in my view. And in America, what's going on in America has kind of quite a lot of vibes of the savings and loan crisis. If
you know, there is such a thing as monopolistic competition between countries, and each one has to run its own little financial.
Has to have its own flagship bank, absolutely. But in America, it's a crisis of the mid-tier banks. It's the equivalent of the German Landesbanken. They're the ones that are getting into trouble this time, and not the very smallest community banks, and not the very biggest banks either. And it's that mid-tier banks who like to be regulated like little banks, but have the protections of big banks. It's that needs to be dealt with.
Okay. Well, thank you very much, Ron. Thank you, Ron. Thank you. We're going to end it here, and I want to end with a quick question for you and a commentary. My commentary is this: do we make anything about Joseph Gentile, who was the former chief financial officer for Lehman Brothers until 2007? You know where I'm going. Who was the chief administrative officer for Silicon Valley? So is this really one person who was just so inept? I'm just going to leave it there. My question to end this is, okay, So now what? Is this going to get worse before it gets better? Quick answer from, let's start with Francis.
Yeah, absolutely, because they're still raising interest rates and there's still lots of hidden leverage in the banks, which is going to get squeezed out. So yeah, it is.
Steve Keen.
Yeah, I think so. We haven't yet seen the impact on credit demand, the scale that I would have expected by now, but I think that's going to come through. So rising interest rates are going to trash asset values and mean people start paying back debt rather than taking on more debt. So that'll cause the macro effect that I was mainly focused upon rather than this fragility effect. But you can't hedge the entire financial system from rising interest rates. Their bonds are going to continue falling in value to put the rates up. There'll be others that fall over because they can't hang on to that hold to maturity for long enough. They'll fold. And the banks, the neoclassicals, are still trying to fight inflation, ignoring what they're doing to the financial system when their primary role is supposed to be preserve the integrity of the payment system. So I might even go buy Bitcoin after this. That's a joke. But so is the financial system these days, thanks to it being run by the Ben Bernankes of the world.
Thank you.
I want to just agree with both, but to say that actually it also has global repercussions and leads to global imbalances, which will just exacerbate global tensions. Sorry about that.
Thank you very much, all three. What an interesting conversation. Thank you for those who asked questions, those who attended, and we'll all see you soon, I hope. Thank you very much.
Bye.
Bye-bye, everyone.
Bye-bye.